European Central Bank just quietly admitted something that gold investors have suspected for years. Under enough stress, gold could expose the financial system's deepest fault lines. Have you ever done that thing where you accidentally say a thought out loud? Well, I think that the ECB just did that. A group of economists at the European Central Bank has issued a warning that rising demand for physically settled gold contracts could act as a red flag, or worse, a trigger for wider instability. Yep. Well, in recent months, gold has been on a bit of a tear. It's broken records, it's changed hands, but now it has apparently broken the nerves of the European Central Bank. According to the ECB's latest note, gold's demand during geopolitical stress could threaten financial stability in the eurozone. Not stocks, not debt, not currencies, gold. And why? Because investors might insist on physical delivery, because vaults might get drained, and because leveraged positions might face margin calls. In other words, the system isn't ready for gold to behave like it always has, as a safe haven when all else fails. And as we've discussed before, there has been a shift toward physically settled gold contracts, not because investors are chasing returns, but because they're losing trust in fiat, in counterparty chains, and in the financial plumbing behind it all. This isn't diversification, it's defection. So let's be clear to anyone new to all this. This is not about gold misbehaving or it being a risky asset. It's about what gold reveals under pressure. That trust in physical gold, not paper capital, is the true collateral of the modern system. It's not that long since COMEX inventories were at record highs, with over 2,000 tonnes shifting from London to New York earlier this year, when we saw the highest delivery notices since 2007, and the ECB has finally noticed. The so-called gold shortage between London and New York, well, it pointed to rising gold borrowing costs, logistical bottlenecks, and a surge in physically settled futures contracts. These weren't signs of dysfunction in gold, but they were signs to the mainstream institutions that trust in paper assets is evaporating. Let's be honest, what central bankers really fear is that gold might actually settle accounts, that it might become not just a hedge, but the scoreboard. Do not forget, gold is the barometer of financial stability. The ECB's biggest fear is a short squeeze, but not on gold miners or ETFs, on their entire financial system. A short squeeze is when sellers must scramble to buy back what they never owned, driving prices higher. In gold, the danger is that those with paper claims start demanding metal, and when vaults can't deliver, the scramble begins. London's gold can be slow and inaccessible in the short term. COMEX demands 100-ounce bars, not London's 400-ounce format. Everything needs resizing. This isn't just inconvenient, it's a pressure cooker. And the ECB tries to maintain composure, insisting gold exposure is still relatively small compared to equities, bonds, or real estate. But then they go and admit that gold still could act as a shock amplifier. Why? Well, let's count the ways. Leverage. Derivatives allow you to take huge positions with tiny amounts of capital. Great in good times, but a horror movie in reverse where markets move the wrong way. Opacity, because contracts are OTC. No one really knows who's on the hook or who might be holding the bag. Concentration, a handful of big players dominate the gold market. If one goes down, the ripple effect could potentially become a tidal wave. Margin calls. If prices move too fast, counterparties need to cough up cash, and that means forced selling, more volatility, and a feedback loop of panic. And a physical squeeze. If people start demanding delivery en masse and the gold just isn't there, then we're not just talking about financial instability, we're talking about institutional credibility just poof, gone in a puff of smoke. Imagine a major counterparty suddenly unable to deliver physical gold. What happens next? Other market participants scramble to cover exposure, prices spike, margin calls explode, central banks, funds, everyone gets dragged in. Let's just look at what the ECB wrote. In the euro area, gross notional exposures to gold derivatives amounted to €1 trillion in March 2025, an increase of 58% since November 24. A significant share of these derivatives contracts are traded over the counter and are not centrally cleared. The majority of euro area banks' gold derivatives exposures are with non-euro area domiciled counterparties. Translation: The eurozone is sitting on a €1 trillion pile of largely unregulated paper gold contracts, most of which are not even cleared through centralized systems. Nearly half of these contracts are bank to bank, and most of those are with foreign institutions. That is a fragile house of cards propped up by trust and some spreadsheets. And here's the kicker. Those foreign counterparties, that is mostly Wall Street. That's the US. So when geopolitical tensions spike, when investors start asking for physical delivery instead of rolling over paper contracts, who gets squeezed? Well, it's not New York. The real pressure lands in London, Amsterdam, Brussels, the historic hubs of that paper gold trading. Euroclear, the city, the Dutch clearinghouses, they are exposed, and the ECB knows it. This isn't a conspiracy theory. It's right there in the footnotes. Washington isn't just playing hardball geopolitically, it's playing hardball monetarily. In the 1970s, the US defended the dollar with interest rate shock therapy. Today, it might just do it with gold. It's a bit like financial judo. The US encourages foreign institutions to stack derivatives like kindling and steps back as the match gets lit. Physical demand rises, trust erodes, counterparties wobble, and suddenly, it's not just a bullion story, it's systemic risk. And here we are, watching a €1 trillion game of chicken play out in the dark corners of the OTC gold market. So welcome to the Everything Crisis. Economist Konstantin Gurdjieff posted a key insight last week. We no longer live in a world of risk. We live in a world of uncertainty and complexity. That shift has broken the illusion of stability. Every new technological cycle, .com, private equity, AI, has promised a solution to systemic problems. Every time the wall of reality hit harder, the real problem isn't innovation, it's the lack of foundational values that can unite economies, policies, and currencies. Incrementum's incredible 2025 In Gold We Trust report describes what's happening in Europe as monetary climate change. Germany, once the poster child of fiscal prudence, has torn up its rulebook. Defense spending, infrastructure, and climate plans are now funded with new debt. The fiscal brake is broken. Yields on bunds, the Eurozone's so-called risk-free asset, have surged. And why is that? Because for the first time in decades, counterparty risk is being priced back in. Central banks are leading the shift to gold. And since 2022, they've added over 1,000 tons of gold per year. As they explain, this is not diversification. It is monetary migration. And investors are catching on. ETF flows are turning. Western buyers, after years on the sidelines, are slowly starting to wake up. COMEX deliveries continue to surge. The demand isn't speculative. It's existential. Because gold, as Jim Sinclair said, is a restatement of wealth. When currencies are devalued, debts explode and trust evaporates. Gold, it reprices the system, and not by crashing, but by revealing. The ECB doesn't fear gold because it is volatile and they fear for investors. They fear it because it's honest and investors are seeing through the illusion. Gold isn't the danger, it's the warning signal, the barometer for risk in the system. And in a world built on opacity, leverage, and illusion, that truth is unsettling the ECB. If you're worried about financial stability, ask yourself, which asset has no counterparty risk? Which asset has lasted 5,000 years? Which asset are central banks quietly hoarding while telling you it's obsolete and risky? Exactly. So let me ask you, are you still trusting the system? And if you are, that's sweet. Meanwhile, the rest of us, we're planning our exit. And if you want to join us, then we've got this nice little download here to help you prepare your exit plan with gold. At Goldcorp, we believe in real assets, real ownership, real protection. It's fully allocated, independently audited, and outside the system. Because when the scramble begins, those with physical gold won't be caught out. They'll be stepping aside, holding the one thing the system can't print: gold.